Hello students, we are discussing the RTP for Jan 2026 attempt and we'll be discussing the question and answer in a quick manner which will be very helpful for you before exams. So my assumption is you have already done this financial reporting subject. So we are not discussing or taking the concepts in a detailed way. We'll take the question, discuss the answer and move on. So let's do case scenario number 1.
X Limited prepares its financial statements based on Ind AS. Of course, it should be Ind AS. X Limited lessee enters into an agreement with Y Limited lessor to lease an entire floor of building for a period of 10 years with an option to extend the lease for 5 years. So, this is Ind AS 116 leases and the lease period is 10 years with an option to extend for 5 years. You know what? As per Ind AS 116, lease period is contract period or agreed period plus renewal period if it is reasonably certain to exercise. At the commencement date, X Limited is not reasonably certain to exercise the option to extend the lease, which means lease period is only 10 years. At the commencement date, we need to identify whether the lessee has significant incentive if lease period is extended. But here there is no information and they have no plans to extend the lease. Lease payments are 50,000 per year during the initial term and 55,000 per year during the optional period. We don't need the optional period information. As per the terms of the contract, lease payments are required to be paid at the beginning of the year. Very important, because we need to calculate the lease liability taking the PV factors. So taking the PV factors, so it is beginning of the year. So year 1 lease liability is already settled at the commencement date. To obtain the lease, X Limited lessee incurred initial direct cost of 20,000, out of which 15,000 relates to the payment to former tenant occupying that floor of the building, and 5,000 relates to the commission paid to the real estate agent that arranged the lease. Okay, so initial direct cost incurred by lessee is 15,000 plus 5,000. And as an incentive to X Limited for entering into the lease, Y Limited agrees to reimburse to X Limited real estate commission of 5,000. So we incurred 15 plus 5. Lessee incurred 15 plus 5, of which 5 is reimbursed, which means initial direct cost is only 15,000. The interest rate implicit to the lease is not readily determinable by X Limited. So IRR is not available. IBR is fine, 10%. Consider discounting factors up to 2 decimals. Now, X Limited has deferred tax asset. See, listen, in an MCQ, in a case scenario, there will be multiple Ind AS. So, next information is starting with deferred tax asset. So, let's time being, don't read this. Let's find out what are the MCQs here. What would be the lease term in the given case? Oh my God, that's so simple. What is the lease term? Option A, 10 years. At what value does the lease liability be recognized initially? So what I'll do, so year 1 we will not consider because it would be already paid, and lease liability is what is payable from year 2 to year 10, and lease liability is 50,000 into annuity factor at 10% for 9 years. Beginning of the year, first year is already considered, so 9 years. So we are taking the factors 1 divided by 1.1, 1, 2, 3, 4, 5, 6, 7, 8, 9 GT 5.75. So 50,000 into 5.75, 2,87,500. So option B. At what value right of asset be initially recognized? See, we can recall the journal entry. What is the entry that we will pass? ROU asset debit to lease liability 287,500, correct? To cash or bank, we are paying now 50,000. 50,000 initially, and also we incurred 15,000. 5,000 is reimbursed, right? So that we are ignoring. So 287,500 plus 65,000, 352,500 is ROU asset. What would be the amount of depreciation to be charged annually on ROU asset? So that is very simple. This divided by lease term. What is the lease term? 10 years. So 35, 250. Yes. Now at what rate deferred tax? Deferred tax information we have not read. Let's go and read. But what is the question? At what rate would deferred tax be calculated? Okay.
X Limited has deferred tax assets recognized in the balance sheet on 31st March 2012 in respect of unused tax losses that can be used to reduce taxable income in future years. Okay. The income tax rate used to calculate the deferred tax asset was 40%. So on 31st March 12, we already recognized a deferred tax asset and the deferred tax asset is 40%, which has current rate of which was the current rate of tax applicable at the balance sheet date. Okay. A new government came to power on 1st April 2012 and passed legislation that on 17th April the income tax rate was reduced to 33% with immediate effect. So, what is the rule as per Ind AS 12? What is the rule? Deferred tax should be measured using the rate which is enacted or substantively enacted. Substantively enacted at the reporting date. Enacted or substantively enacted at the reporting date. So, this is reporting date is 31st March 12. It's not enacted nor substantively enacted. So, we cannot consider this 33%, only 40% can be considered. Only 40%. So, what is the deferred tax rate to be considered? 40%.
Easy. Case scenario number 2. A Limited enters into a 3-year contract to provide 1,000 hours of standard call center operator time per annum for 6 lakhs. 2 lakhs per year. The standalone selling price at inception. So this is from which standard? Ind AS 115. So the contractor has entered into a 3-year contract to provide 1,000 hours and amount fixed is 6 lakhs, that is 2 lakh per annum. So which means we will recognize 2 lakh, 2 lakh, 2 lakh over 3 years. At the end of first year, the contract is extended for another 3 years at 6 lakh 60 as follows. Year 1, year 2, year 3, and at the end of year 1, contract is extended for another 3 years, means there will be year 4, year 5 and year 6. In accordance with the contractual provisions, the fee for first year is reduced by 90,000 because of highly defective service. Very bad. So you are charging for the first year 2 lakhs. You have done the performance obligation, but highly defective service. So how much revenue can be recognized in first year? 1,10,000. How much revenue can be recognized in the first year? Only 1,10,000 because of highly defective service. 90,000 is to be reduced. Okay. The contract is extended for another 3 years for 7,50,000, 2,50,000 per year when the standalone selling price is 2,30,000. So even if the standalone selling price is only 2,30,000, you have extended for 3 more years and you are charging 2,50,000 additional. Okay, fine. So further, government has significant influence over L. L has significant influence over A. So this is a question from Ind AS 24. Let's not read this now. So what is the accounting to be done in the first case? So there is year 1, year 2, year 3, year 4, year 5, year 6. First year you have already discharged your performance obligation and you can recognize a revenue of 2 lakh. But because of highly defective service, 90,000 is to be reduced. So 1,10,000 is the revenue that can be recognized. Okay. Now at the end of year 1, the contract is modified. Contract modification. So what is the provision as per Ind AS 115 with respect to contract modification? See, if the contract is modified to add distinct goods and services. What is the provision? Contract is modified to add distinct goods and services at standalone selling price. Then if both the conditions are satisfied, the modification should be treated as a, if you added 3 years, if distinct goods and services at standalone selling price, it can be considered as a new and separate contract. That is the provision as per 115. If that is failed, adjustment to be made to the existing contract. Do you remember that provision? So here it is distinct goods and service, 3 years added, but not at standalone selling price. It was given 2,30,000 is the standalone selling price, but you are charging 2,50,000. So it's not at standalone selling price. One condition failed. If one or none failed, both satisfied only new and separate contract. So one failed, it should be adjusted to the existing contract. The accounting should be done as there is a modification in the existing contract. So here, and there is one more doubt. You have one more doubt. It is given that contract is extended for 3 years at 6,60,000, but the same line contract is extended for 3 years at 7,50,000. Why the mismatch? It's not mismatch. It is 7,50,000 minus 90,000. Originally 90,000 they are reducing, right? So originally it was 6 lakhs. So it's not mismatch. It is 7,50,000 minus 90,000. So in effect addition is 6,60,000. So already it was 6 lakhs plus they are adding 7,50,000 minus they are deducting 90. So that is why it is 6,60,000. Okay. So this is the scenario. Now what are the questions? What amount to be recognized in year 1? Oh, that is very basic. 2 lakh minus 2 lakh is the revenue to be recognized for the first year, but minus 90,000 of highly defective service, it is 1,10,000. What will be the accounting treatment for contract extended at the end of year 1 with respect to its revenue recognition? What is the treatment of this modification? The modification in the contract will be accounted prospectively by allocating remaining revenue equally over 5 years. At the end of first year only there is modification. So the remaining income. So how much is the remaining income? It was 6 lakhs originally and plus 7,50,000 minus 90. So 6,60,000. So total is 12,60,000. Of which they have already recognized 1,10,000. That is 11,50,000 is the balance. The correct treatment is this 11,50,000 should be spread over 5 years. So that is the correct option, but let's read the other options also. The modification in the contract will be accounted retrospectively. No. The modification in the contract will be accounted as separate contract. No. The modification does not fall within the purview of 115. No. So this is option A is the right answer. Now, what will be the remaining total revenue? Oh, we already calculated 11,50,000. That is 12 lakhs. Again, if you want me to repeat, it is 6 lakhs already. Plus 7,50,000 we added. Minus 90. This is the total contract revenue. Of which 1,10,000. Why 1,10,000? 2 lakh was the revenue, but 90,000 is reduced for the first year. So that should be allocated to the first year only, 1,10,000. So that is how balance 11,50,000. And what is what is the revenue to be recognized in year 2? Of course, 11,50,000 divided by 5 years. That is 2,30,000. Okay. Now what is that? Now, state which of the following statement is correct with respect to transactions A, K, between A, L. So that is in days 24. Let's go and read this. Government G has significant influence over L. Okay, government G has significant influence over L. L has significant influence over A and control over K. So L is having a significant influence over A and L is controlling K. All the entities have transactions with each other. Okay, fine. So state the following statements is correct with respect to transactions between A, K and A and L. See here, A and K are related parties because a common investor is one is having significant influence and other is having control. If the same investor is having significant influence and the same investor is having control, then A and K are related parties. A and L are related parties. L and K are related parties and all are related parties, and disclosure exemption is only for those transactions between government and if the government is having transactions with the if the government is having transactions, there are disclosure exemptions and few exemptions which you already know. But otherwise, disclosure is required. What is the question? State which of the following statement is correct with respect to transactions between A and K and transactions between A and L under Ind AS 24. Transactions between both A and L and A and K are not disclosable. It is wrong. It is disclosable because it is related party transactions. So transactions between A and L, A and K are not disclosable. Wrong. It is disclosable because it is related party transactions only. Transactions between A and L are not disclosable, but transactions between A and K are not disclosable. Again, wrong. Same thing, ulta. One is disclosable, one is not disclosable. Wrong. Transactions between both A and L and A and K are disclosable. Yes. Okay. So the next question is in days 102 share-based payments, and I'll say this question is the superstar in this entire RTP. This type of question you have not done before, totally new type of question. So H Limited is a parent company and has a subsidiary S Limited. H and S are unlisted entities. Okay, following arrangements with respect to ESOP scheme took place between them. So I really want students to note this question and try before exam because it is totally new. There is a higher probability that I may ask the same question for your exam. So there is original ESOP scheme by H Limited, parent ESOP scheme. So we know parent ESOP scheme, parent company issuing shares to the employees of subsidiary. We know that in the books of parent will be debiting investment in subsidiary and subsidiary will be crediting. In the books of subsidiary will be crediting capital contribution from parent. So here, what is this? At the beginning of year 1, H Limited is the parent, H Limited granted 1,500 options in its own shares to its employees as well as S Limited's employees, 1,000 to H Limited's employees and 500 to S Limited's employees with a fair value of 15 per options. Conditional upon the completion of 3 years service, H Limited will settle in its own equity shares and all the options are expected to vest. H Limited doesn't recharge to S Limited for ESOP expenses. So what is this? Let's find out. So the parent company is issuing shares to its own employees, 1,000 shares, and to the subsidiaries employees, 500 shares. So what is the accounting? If parent giving shares to own employees, it is employee benefit expense to SBP reserve. So it is 1,000 into 15. So it is 1,000 into 15 divided by 3 years. So employee benefit expense to ESOP reserve is 5,000. And also it is giving to subsidiaries employees. So 500 into 15 divided by 3 years. It is 2,500. So employee benefit expense debit 5,000. Investment in subsidiary 2,500 to SBP reserve 7,500. That will be the journal entry. Are you okay? And in the books of subsidiary, it is employee benefit expense, because employees are working in subsidiary companies, so the employee services are received by subsidiary company. So employee benefit expense for 500 employees should come in the books of subsidiary. So employee benefit expense debit to 500 to, is it SBP reserve? No, to capital contribution from parent, because the shares are issued by parent company. So it is capital contribution from parent. Okay. Now, so if there is nothing great, the same journal entries will be repeated, and after the vesting period or on the exercise date, parent will be issuing shares, SBP reserve to share capital. But here there is a change. This part, what is given? New ESOP scheme by S Limited subsidiary. H and S are unlisted entities. However, at the end of year 1, S Limited gets listed. Subsidiary company is becoming listed company at the end of first year, and at the beginning of year 2, S Limited offers 1500 options in its own shares to H Limited's employees and its own employees, conditional upon H Limited and S Limited employees surrendering the right over the parent ESOP scheme. This is the twist in this question. See, it was holding company. Originally, the one decided to issue shares to employees of parent and also employees of subsidiary. It was parent company who originally decided to settle the ESOP scheme. But now suddenly the company, they have decided the shares will be settled by, the settler has changed. The issuer has changed. The parent company has given the right to issue shares to subsidiary company. And the subsidiary company will be offering 1500, same 1000 and 500, but now it will be issued by subsidiary. Now, what change should come in the books of parent? What change should come in the books of subsidiary? And is the fair value same? Originally, parent was the one decided to issue. So, fair value is decided from the point of view of parent. Now, it is agreed to be issued by subsidiary. So, of course, the incremental fair value given for the new scheme, incremental additional expenses 6. What is the treatment of incremental fair value? So, as per Ind AS 102, if there is a modification can be decreasing the benefits of employees or increasing the benefit of employees. If decreasing the benefits, no special accounting, but increasing the benefits, we need to find out incremental fair value, and incremental fair value should be spread over the remaining vesting period, that is 2 years vesting period. All the options are expected to be vested, and all H&S employees are opted for the new ESOP scheme. S Limited doesn't recharge to H Limited for ESOP expenses. So there is a change. Year 1 I already passed journal entries, but year 2 beginning there is a change. So what change I should bring in? And what are the entries at the end of year 2 and what are the entries at the end of year 3? What is the accounting in the books of parent, subsidiary and consolidated financial statements? So what is the accounting to be done? So please listen. What is the accounting? So this is equity settled plan. So what is the first? So I'm writing like this. Originally in the books of parent, what was the entry? Originally in the books of subsidiary, what was the entry, and what is the accounting to be done when the settler, issuer has changed? So very conceptual. So let's find out what is to be done. Let's find out what is to be done. So first, in the books of parent, employee benefit expenses. Employee benefit. Why employee benefit expense in the books of parent? Because parents, employees, if the employees are working with parent company, employee benefit expense should come in the books of parent. So employee benefit expense, 1000 employees into 15 divided by total divided by 3, 5000. Investment in subsidiary, 500 employees into 15, all divided by 3, that is 2500. To SBP reserve, 7500. Now in the books of subsidiary, only subsidiary related entry should come. So employees are working with subsidiary. So employee services received by subsidiary. So employee benefit expense 2500. And correspondingly there is capital contribution from parent. I'm purposefully writing short form to make it fast. From parent 2500. This is my first entry and everything is this is the first entry and everything is fine, but suddenly there is a change. So when there is a change, what should be the entry at the beginning? At the time of change, what is the entry? This is year 2 beginning. What is the change? In the books of parent, already there is SBP reserve, but SBP reserve is not going to be settled by parent. So I need to reverse SBP reserve. Are you convinced? Because SBP reserve should come now in the books of subsidiary. So SBP reserve is to be reversed, 7500. No free shares are to be issued to the subsidiary company's employees, or to investment is to be reversed. To investment, 2500. Now the question, employee benefit expense to be reversed? No, because those employees will still get shares from subsidiary company and employee services received by parent. So employee benefit expense should come, but employee benefit expense too. It's not me issuing shares. The shares will be issued by subsidiary. So what is the entry that should come in the books of? If this is to be settled by subsidiary, this is cancelled. This is cancelled. Employee benefit expense too. I can listen you all saying dividend income, return on investment 5000. Yes or no? So very important. I'll say this is again the superstar, because in days 102 is not addressing the issue what to be done when the settler has changed. And here the settler has changed, and this is very much conceptual, the set of journal entries. And what will be the accounting in the books of subsidiary? In the books of subsidiary, share-based payment reserve should come, 7500. Then capital, no capital contribution from parent. No capital contribution from parent. So I reversed. Now I need to give shares to the employees of my parent. I'm giving a benefit to my parent. So I should recognize dividend distribution. Dividend, retained earnings should be debited. Dividend, so, or equity, retained earnings to be debited, 5000. Are you understanding? If there is a doubt, please comment so that I can explain it, clarify it. So dividend is to be debited. Now this is the correction entry. Now what is the entry at the end of year 2? End of year 2, what will be the journal entry? In the books of parent, in the books of subsidiary, at the end of year 2. At the end of year 2, parent company will be getting, parent company's employees will be getting shares of subsidiary company. So again, employee benefit expense, how much? 1000 employees, 1000 shares into 15 is the fair value. And this is 2/3, second year 2/3, of which 5000 is already recognized. Correct. Plus, there is an incremental fair value, additional benefit, which is to be spread over 2 years. Incremental benefit, incremental fair value should be spread over 2 years. So this is 5000 and this is 3000. So employee benefit expense debit 8000. Are you clear with the calculation? Just process this. From the existing plan, only the settler has changed. From the existing plan, employees will be getting benefits, and also there is an incremental fair value, additional benefits. Incremental fair value or the modification happened at the beginning of year 2. So year 2 and year 3 I need to recognize this additional expense. So this will be given to me by my subsidiary company. So 2, dividend income 8,000. And in the books of subsidiary company, what will be the journal entry? Subsidiary is giving SBP should issue shares to odd employees and also parent company's employees. So employee benefit expense should come for sure. My employees, how much should be given to my company's employees? 500 into 15 into 2 by 3 minus 2,500 already recognized. And also to my employees 500 into 6 into 1 by 2. So how much it is coming to? 4,000. 2,500 plus 1,500. And also dividend I'm giving for my for the employees of my parent. So dividend / equity. So I need not find out the expense. That's straight here. To dividend expense is 8,000. So dividend income is 8,000. Dividend expense. Same calculation for my subsidiary. So it is same calculation for my parent. So dividend is 8,000. To SBP reserve 12,000. Now end of year 3. Same entry. And finally SBP reserve to subsidiary company SBP reserve to share capital. This is the calculation required. Okay. So this is a very good question. Be clear. And in case of doubts you can comment below. So that's it. And so what will come in parent, what will come in subsidiary? There is one more question. What will come in consolidated financial statements? In CFS, subsidiary companies books, there will be an SBP reserve. In subsidiary companies books, there is an SBP reserve. So this SBP reserve will be allocated to NCI in consolidated financial statements. Why? Parent is having investments in subsidiary. Say if parent is having, say for example, 100% shares in subsidiary. But subsidiary will be issuing shares to, already there is a contract to issue shares to employees, outsiders. The share issue is not towards, it's not for parent, this is for outsiders. So which means that SBP reserve represents NCI. Are you clear? Yes. Okay. Now, so that was a very important question. I feel you need to practice and you need to be very clear. Yes. What is next? Question number 12. Again, question number 12. First, you should have seen or the provisions, studied the provisions of Ind AS 21. Let's read the question. Parent A Limited is the reporting entity that has net investment in foreign operations in 2 foreign subsidiaries, B Limited and C Limited. So there is a parent company A Limited and 2 subsidiaries B Limited and C Limited. Okay. In all the following scenarios, loan made between group entities are permanent in nature. Do you remember this provision? When the settlement is neither planned nor likely to occur, the loan or the benefits, interest given by the parent to subsidiary should form part of net investment in foreign operation. Okay, that is in the books of parent company. There is a foreign subsidiary, investments in foreign subsidiary on the asset side, and also there is a loan given to foreign subsidiary. And this loan given to foreign subsidiary is not planned, repayment is not planned, nor expected to happen in foreseeable future. Then this loan is in substance treated as investment in subsidiary because it's like a permanent investment and I will not get any repayment or not likely to happen in foreseeable future. So it should be added to the net investment in foreign subsidiary. So here let's find out what is the accounting treatment. The accounting treatment is in the books of parent company. Accounting treatment is in the books of parent company. Loan given is a monetary item. Loan given is a monetary item. Of course, the gain or loss will be recognized in P&L. Foreign currency fluctuations, gain or loss will be recognized in P&L. And in consolidated financial statements, the gain or loss in P&L is reclassified from P&L to OCI. It should be reclassified from P&L to OCI. This is the accounting treatment as per Ind AS 21. Now let's find out what is the question here. What is the scenario 1? Parent A Limited with sterling as its functional currency is preparing its financial statements to 31st March 2015. So parent A, sterling, pound is the functional currency, is preparing financial statements to 31st March. It has a loan receivable asset of US dollar 1 million. Oh, my currency is pound and I have given a loan in US dollar 1 million, 10 lakhs. So loan receivable from its subsidiary, which means loan given to subsidiary, that has been outstanding for some time. The parent notified the subsidiary at the beginning of financial year that no repayment of amount will be requested for the foreseeable future. The relevant exchange rates are as follows. US dollar 1 pound is equal to US dollar 1.82 at the end and 1.45 at the beginning. So what will be the accounting? So the accounting is in the books of parent and in the books of subsidiary. In the books of parent, this is a foreign currency loan. But because parent's functional currency is this pound and subsidiary's functional currency is dollars, so parent has given loan in dollars and subsidiary has received it in dollars. So there is no foreign currency fluctuations in the books of subsidiary. But there will be foreign currency fluctuation effect in the books of parent. Yes or no? Because parent's currency is pound. Initially, loan given will be accounted. Initially, loan given will be accounted at. So I need to be careful. This is 10 lakhs dollars and don't multiply it. It is given in dollar only. So 1.45. 10 lakhs divided by 1.45. 6 lakh 89,655 is the value of, it is the value of pound which we initially recognize. Loan to bank is this amount. Subsequently, when there is a change in the exchange rate, 10 lakhs divided by 1.82. 10 lakhs divided by 1.82. Loan receivable has become 5,49,450. As a result of this, initially this was the 6,89,655 pound. Now it has become 5,49,450 pound. So difference 6,89,655, 1,40,204 pound will be recognized as exchange loss in P&L. Will be recognized as exchange loss in P&L in the separate financial statements of parent. In the separate financial statements of parent, this will be recorded in P&L. Yes or no? This will be recorded in P&L. But when we prepare consolidated financial statement from the parent's P&L, it will be reclassified to OCI. This is the answer which I need to write. In CFS, from P&L, this should be reclassified to OCI. Okay. And the facts are same in the above scenario, except that parent A Limited has a loan receivable from subsidiary C Limited of 2 lakh pound that has been outstanding for some time. Facts are same except that parent has a loan receivable from subsidiary. Subsidiary should pay 2 lakh pound, which means parent has given 2 lakh pound. From parent's point of view, what is the currency of parent? Pound. In what currency they have given? Pound. So there is no foreign currency fluctuation in the books of parent. The loan is treated as parent A Limited as forming part of its net investment. This is also not expected to be repaid. Determine the treatment of exchange difference in standalone financial statements of both subsidiary, parent and CFS. So if there is a foreign currency fluctuation in parent, record it as loss in P&L, then it will be reclassified to OCI. In the first scenario, no impact in subsidiaries books. Parent company, there is an exchange loss, and in CFS it will be reclassified to OCI. In the second scenario, it is reverse. What reverse? In the books of parent has given the currency in pound only. So no exchange gain or loss in the books of parent. But in the books of subsidiary, initially 2 lakh pound means 2 lakh pound into 1.45 was the liability. 2 lakh into 1.45 was the liability. That is 2,90,000 was the liability. Initially, I'll be recognizing liability. But year end it has become 2 lakh into 1.82. 2 lakh into 1.82, it has become 3,64,000. So 74,000 will be recognized as exchange loss. Exchange loss in dollars. 74,000 exchange loss in dollars in the books of subsidiary will come. So this exchange loss in subsidiary, which is originally in P&L, when we prepare CFS, are we preparing it in pound or are we preparing it in dollar? Can I get an answer from you? Are we preparing CFS in dollar or are we preparing CFS in pound? Consolidated financial statements. Consolidated financial statements we'll be preparing in pound. Why? Pound. What is the reason? Because parents' currency, thank you for the response, parents' currency pound. So this is in dollar. So 74,000 divided by year end. What is the exchange rate? 1.82. 74,000 divided by 1.82. 40,659 pound. Exchange loss was originally in P&L. It will be reclassified to OCI in CFS. I used to say in class, in almost every standard, it's like OCI reclassified to P&L, OCI reclassified to retained earnings. In the entire Ind AS, there is only one scenario that is P&L to OCI. P&L to OCI only in one scenario, that is Ind AS 21. Ind AS 21, this Ind AS 21, originally in the parent or subsidiaries, P&L, exchange loss in P&L, exchange gain or loss in P&L will be reclassified to OCI as it is unrealizable. The loan is not expected to settle in foreseeable future. So reclassification is to be done. So that is the accounting treatment, which is actually easy. Unlike in this 102 question, here I feel already this type of questions are in the material easy. In days 8 is very easy. So all these questions, easy questions, I need to move on fast because already similar questions are there in the material. In days 8, I'm reading in days 8. During 2013, T Limited discovered that prepayments of 680 made during 2011 had not been recognized in P&L as the related expenses were incurred. Oh, prepayments we made in 2011 had not been recognized in P&L as the related expenses were incurred. Prepayment should have been recognized as expense 170, 425 in 12 and 85 in 13. So total prepayments were 680, and the 680 should have been recognized as expense in each year but has not been recognized, which means expenses were recognized less in each year. The misstatement is material. Okay, so what is given? Revenue 2012 6800, expenses 6120. No, the expense should have been 6120 plus 2012. How much is in 2012? The expense should have been recognized as 425, which is not recognized here. So the expense should have been 680. Sorry, expense should have been 6120 plus 425, and here expense should have been 9350 plus 85, and there is statement of change in equity is given. Opening balance of retained earnings is adjusted and comparatives are restated when practicable to reflect the correction of the error. Assume there are no tax effects. Draw the revised statement of P&L extract and changes in equity after rectifying the above error. Okay, easy, that we'll do. So when we prepare the P&L extract, we are preparing the P&L extract. So this is previous year 2012 and this is 2013. So revenue given is 10,200 and 6,800. Expenses 6120 plus 425, 6545, and 9350 plus 85, 9435, and the 6800 minus 6545, 255 is the corrected profits, 10,200 minus 9435, 765 is the corrected profits. Okay, what about, is it that simple? Nothing more, nothing more. Statement of changes in equity. What should I do in statement of changes in equity? Statement of changes in equity, again, how should I start? Opening retained earnings. So there are 2 years. Opening retained earnings. How much was the opening retained earnings? 23,800. Previous year. This is restated or corrected. Opening retained earnings was 23,800. And we need to do an expense unaccounted in the first year, 170. So it is 23,800 minus 170, 23,630, and current year profits. 2012 current year profits is, we have identified the current year profits as 255. So it is 255 plus 255, it is 23,885. And here 2013 opening retained earnings is 23,885. That is nothing, 23,885. And current year profits is 7. It is 24,650. So it's a very basic question. I hope this is okay. Anything doubts on it? If there is any doubts coming on your way, you can ask in the chat box. I'll clarify. Clear. Okay. So I think we can move on. So question number 14. Again, question number 14. I feel this is easy question. Question number 14. But definitely this question is not from your SM or RTP, which you have not seen this question before. So this is a good one. You have not seen this before. Let me read. A Limited enters into a contract with a customer for the exclusive supply of paint for a 3-year period. We entered into a contract for supply of paint for 3 years. A Limited makes a 5,000 upfront payment which the customer will use to customize its paint sprayers for A Limited's product. A Limited estimates 10 lakhs in sales with customer over 3-year period. Okay, 3-year period, total sales expected is 10 lakhs. Sales for quarter 1 is 1 lakh and for quarter 2 is 1,25,000. However, A Limited updated its estimate of total sales over contract to 15 lakhs during. Oh, here it is. A Limited made the payment. A Limited has given the payment. A Limited will receive 10 lakhs and A Limited has given the payment. Okay, A Limited, it's not upfront fees we received, it is upfront fees we have given. Okay, we have given. Consideration given to customer. We have given the upfront fees to the customer. A Limited makes 50,000. A Limited paid 50,000. Which the customer will use to customize is okay, fine. So A Limited estimates 10 lakh sales with the customer over 3 year. Sales for quarter 1 is 1 lakh and quarter 2 is 1,25,000. However, A Limited updated its estimate of total sales over contract to 15 lakhs during quarter 2. Determine, when I read this net revenue only, I noticed it is given to customer and customer has given me sales of 10 lakhs. So that is how net revenue in quarter 1 and quarter 2 by A Limited. So A Limited is getting a total sales of 1 lakh in quarter 1. Yes or no? A Limited is getting 1 lakh in quarter 1. Normal course revenue is 1 lakh. But I got a upfront fees. Already I have given an upfront fees of 50,000. I have given an upfront fees of 50,000. So what you should do? It should be spread over the remaining contract period. So what we should do? 1 lakh is the revenue I am receiving from this contract of 10 lakhs. Which means in the first quarter, 10% income I am getting. I am getting from the total contract revenue I expected was, total contract the revenue I expected was 10 lakhs. For the total contract, I paid an upfront fees of 50,000. So in the first quarter, how much percentage of revenue I am recognizing? 10 percentage, 1 lakh. So accordingly, 10 percentage of 50,000, 5,000 is to be reduced and revenue to be recognized is 95,000. So in this contract, I am paying 50, I am getting 10 lakhs. This 10 lakhs, this is not just for 1 year, this is for 3 years. So first quarter, how much upfront fees can be adjusted? So I found out the percentage out of the total 10 lakhs. 1 lakh is in Q1. So which means 10% in Q1. So 10% is adjusted, 10% of 50,000 is adjusted. Did you get that? Similarly, in second quarter, listen, in second quarter, 1,25,000 is the revenue I am expecting. 1,25,000. But the total sales expected has changed to 15 lakhs. Total sales has expected has changed to 15 lakhs. Which means now what I'll do, when there is a change in estimate, we'll go for cumulative catch up, cumulative adjustments. So Q1 plus Q2 together, total sales Q1 plus Q2 together, 2,25,000 is the total sales. Divided by Q1 and Q2 together, how much sales has already happened? I'm taking the percentage. So total has revised to 15 lakhs. So 2,25,000 divided by 15 lakhs So 15 percentage is the total sales has already happened. So revenue to be recognized in Q2 is 1,25,000 minus upfront fees received. Upfront fees 50,000 is the total upfront fees which we have given to customer, of which 15 percentage of work has already been done, of which 5,000 already recognized in quarter 1. So 50,000 into 15% minus 5,000 to 500 will be adjusted. So 1,25,000 minus 2,500. Revenue to be recognized is 1,22,500. Revenue to be recognized is 1,22,500 for quarter 2. Just think about it. Okay, my Q1 revenue was 1 lakh. My Q1 revenue was 1 lakh. Q2 revenue was 1,25,000. How much upfront fees will be adjusted? Upfront fees 50,000 was for 3 years. But just divided, I'm not just dividing by 3. I have to find out the percentage of work done. Quarter 1, how much is the percentage of work done? 1 lakh divided by 10 lakhs, it is 10%. So 50,000 into 10%, 5,000 of work done and 1 lakh sales. So recognized a revenue of 95,000. Second year, there are change in estimates. So what I'll do? What is the percentage of work done? 2,25,000 divided by 15 lakhs. That is 15 percentage of work done, of which I've already recognized 10 percentage in the last quarter. So how much more revenue I can recognize? Just 50,000 into 5% to 500. So 1,22,500 is recognized in quarter 2. Are you okay? Yes. Then question number 15. Question number 15 is actually an okay question, but when there is a higher probability that we may end up in a mistake if I'm not reading the question carefully. Question number 15. A Limited has issued optionally convertible debentures. So we know what is optionally convertible debentures. 300 crores to B Limited. Okay, but option with whom? Let's find out. Optionally convertible debentures. Tenure is 4 years. Coupon nil, maybe no interest during this period. IRR 15% per annum, but internally they're getting a revenue of 15%. During the tenure of this OCDs, A Limited can call the OCD and redeem it with stated IRR. Okay, A Limited can redeem it also. The market rate for similar debt without conversion option is 17% per annum. So I have a confusion. Market rate is 17%. What is this IRR? Why IRR is given? So that is it based on the original contract? I don't understand this. So let's read further. B Limited can also ask for conversion at any time before maturity based on the following formula. So B Limited can ask for conversion. So B Limited is having the option to convert the debentures into equity shares. And how many equity shares B Limited can get? Investment amount, that is 300 crore, 300 plus applicable IRR. Oh, this IRR means if you invest 300 today, after 4 years, what will be the maturity value? No interest will be paid, but the maturity value, if it is higher, then the investor is getting a return. So that return is what? 15% is the return as per the contract. So applicable IRR. Applicable IRR is not just 15% per annum. So what should I do? 15% plus 15% plus 15% plus 15% will be the return. So 300 into 1.15% for 4 years, or just I'm doing 300 plus 15% to 3, 4. You will be getting 524.7. 525 is the maturity value. Divided by 10 is the number of shares that can be asked for. Okay, fine. If redemption or conversion doesn't happen before maturity, if before 4 years, if there is no conversion, then this optionally convertible debentures will be redeemed mandatorily at maturity in the same manner. How is this instrument accounted for in the books of A Limited in the following two scenarios? In the books of A Limited, how this will be accounted if B Limited opts for conversion before maturity? See, whatever it is, in the books of A Limited, this is a compound financial instrument. What we should do first? It should be divided into equity and liability. Yes or no? Equity and liability at the inception. How much equity, and how much liability? How much equity? How much equity will be accounted? Equity is the residue, balance. So the liability will be year 1, no interest. Year 2, no interest. Year 3, no interest. Year 4, I need to pay 525. So no, the maturity value I need to calculate 525. It should be discounted at present value factor at 17% for 4 years. So 525 1 divided by 1.171 2 3 4 0.5336 0.5336 into 525. It is 280 liability. So 300 is the issue proceeds. If liability is 280, equity is 20. Yes or no? So the first accounting entry will be, first accounting entry I'll be passing is, first accounting entry I'm passing will be bank account debit. I got 300. So to equity, I'll recognize 20. To debenture liability, I'll be recognizing 280. Debenture equity, debenture liability. Then what happens further? Further, this liability will be unwinded. I'll prepare the table for liability. 280. Interest will be recognized at 17%, 47.648. There is no repayment, so 280 plus 48, 328. Year 2, 328 into 17%, that is 56. No repayment, so 56 plus 328, 384. Then 384 into 17%, that is 65 for 49. And here 449. And finally it should be 525. We will repay 76. This should be the unwinding. Unwinding. I need to prepare amortization table and I should do the unwinding. And the first question is, what if B opts for conversion before maturity at the end of year 1? At the end of year 1, what is the liability in my books? Liability. If I already convert at the end of first year, then should I do this? This part is not required. Yes or no? If I am converting at the end of first year itself, this 328 only I need to reverse to share capital. I will not do this. Okay. Now what is the accounting when B doesn't opt for conversion and OCDs are redeemed at maturity? Then entire year I'll passing the entry liability, interest to liability, interest to liability, interest to liability, interest to liability, and finally liability to bank. Equity will be reversed to retained earnings and liability to bank. Are you clear? So you might have tried a question like this. Then what is the extra? What do you say this is different or something extra calculation? See, extra calculation is this redemption value. And when IRR is given, don't get confused. and a formula is given to find out the maturity value. Just find out the maturity value using the formula. So don't get stressed out if such a question comes for exam. Just be clear. Okay, maturity value I need to find out, and this is zero coupon. Zero coupon means no interest in between, but the redemption value will be a higher amount which I need to find out. So if you have a confusion, I'll show you the solution also. Question number 15, right? Question number 15. 15. Yeah, 15. So first you got 300, to equity 20, to liability 280, debentures 280. Then subsequent accounting, interest to debentures. At the end of first year, you opted for conversion. Then the liability value is 328. How 328? 280 plus 48, 328. If you opted to share capital. Then if they are not opting for conversion year end, then it will be debentures to bank, entire 525 debentures to bank. Do you get this? I hope this is clear. Equity is already there. In the first case, equity already there, so it will be converted to equity share capital only. First, second case, equity, there is no change in equity. Equity is already in the other equity, and if the debenture holders are asking for cash, equity will be reclassified to retained earnings. That just name change, debenture equity to retained earnings. Entry will come. Now, 16. Question number 16 is again an easy, okay, manageable question. Mr. A, B, and C have direct interest of 40%, 10%, and 10% respectively of Trust T. The remaining 40% interest in Trust T is held by 20 unrelated investors. So, A, B, and C, 40%, 10%, 10% in Trust T. So this together is 60%, and balance 40% is held by 20 other unrelated investors. Mr. A, B, C wish to control. Yeah, they can control because they together have 60%, so they can control the trust, so they enter into a contractual arrangement to act together. In this situation, assume one person interest constitutes one voting right. So which means in the trust, 60% is held by ABC, and they formed a contractual arrangement, means they formed a joint arrangement to control trustee, and this 40% is held by other set of investors. Okay. S Limited is a wholly owned subsidiary of P, and P is the wholly owned by Trust T. So Trust T holds P, and trust that this P is the wholly owned subsidiary, S is the wholly owned subsidiary of P, which means trust is owning P and P is owning S. Okay, fine. Should a group of persons be disclosed as ultimate controlling party when they have a contractual arrangement to act together? Yes. The ultimate controlling party of this S is ABC, because ABC controls trust, and trust controls P, and P controls S. So S is ultimately controlled by joint arrangement ABC. Did you get that? It's ultimately controlled by joint arrangement. So that is correct. So the answer is like, do you need to see the answer? What is given? If there was no joint arrangement, then We cannot say that. Otherwise, if there is joint arrangement, this is question. Let me show you the answer. OCD after that. Yeah. They have given a pictorial representation. What is given here? ABC together controls trust, then P, and then S. S Limited's management should disclose ABC as the ultimate controlling party of the group. Okay. When they have contractual arrangement to act together. So the agreement 60%, the rest they have just explained. Trustee should be disclosed as the ultimate parent of S in the notes to the FS. If this information is not disclosed elsewhere in information published with financial statements. Now, trustee would be the ultimate controlling party of S and only Mr. A would be the related party of S if there is no contract, if the contractual arrangement does not exist. If there is no contractual arrangement, who will be the ultimate controlling party? Trustee. Because trustee, there is no other controlling party. Then only Mr. A will be having significant influence in trust if there is no contractual arrangement. But there is no question like what if there is no contractual arrangement? Here the answer is this part. Did you get that? Anything more to be explained? If there is like before you said once more, if there is a doubt, you just tell me once more, I'll explain. Because here my agenda is to make the things fast because it's for Jan 26 exams. More explanations maybe you might have already done. I don't want to waste your time. So question number 17 is again a super easy question in days 2. So listen. Entity manufactures an equipment in 3 stages. There is a market for semi-finished product for each stage, but the entity only sells the completed equipment. Semi-finished work in progress stage also we can sell, but we are selling only the completed equipment. The following are the details of the cost structure. Stage 1, 170 is the cost and selling price is 130. But we are not selling at this stage. Then stage 2, incremental cost is 35 and selling price is 195. Incremental cost is 62 and it is 267 and selling price is 275 because only when I complete it and sell I'll have a profit and I'm not selling it in between. Okay, fine. So what is the question? Assuming that the selling costs are 0, there is no disposal cost. What is the NRV of the semi-finished product in stage 1 and stage 2? What is the NRV of the semi-finished product in stage 1 and stage 2? So what should I do? What is the total NRV which I am expecting to get? The total NRV which I am expecting to get is 275. Total NRV. So I am not planning to sell at these stages. So total NRV I am planning to get, I'll be getting is 275. Total NRV I'm expecting to get is 275. Is stage 1 and stage 2 are not completed. Stage 1 cost is 35 and stage 2 cost is 35 and stage 3 cost is 62. So 275 minus 35 minus 62. It is 178. So 170 is the conversion cost. 178 is the NRV which I will be using. Did you understand? Not 130 because I have no intention to sell, but NRV at this stages I'll be selling only after completion and cost of completion I have deducted, it is 178. So stage 1 NRV is 178. So asset will be still valued at 170. And at stage 2 my total cost is 205. But I'll be selling only if I complete complete the product. So it is 275 minus 62. 275 minus 62. 213 is the NRV. So cost is 205 compared with 213. Still, so 213 and 205, still the cost will be shown as 205. 213 will be ignored because NRV is higher. Cost and NRV, whichever is higher. 213 I'll ignore, 205. So what, assuming selling costs are 0, what is the NRV? NRV is 178 and 213. 178 and 213. Did you get that? How do I calculate NRV of the work in progress? NRV of the work in progress is expected selling price minus cost of completion. Expected selling price is 275. Cost of completion I deducted. That is how we got 178. Did you get this? This is such a basic question. I don't think there will be a confusion. This is such a basic question. Now, in days 23 is, question number 18. In days 23 is very, very important question. Very important 18. Question number 18. Actually, this is the, 19 and 20 are very much okay. 18 is very important. Entity has borrowed 10 lakhs specifically to finance the cost of constructing a new head office. Entity has borrowed 10 lakhs, okay. The loan was availed on 1st May. Interest was payable at 12% per annum up to 1st February. After which the rate has become 13%. So up to Feb next year. So 1st May, June, July, August, September, October, November, December, January. For 9 months it is 12%. But February it is 13% due to an increase in the secured overnight financing rate. Construction of the building does not begin until 1st December. So which means 1st December only I should start capitalizing the interest. Construction of the building does not begin until 1st December means till December there was no construction activities, capitalization cannot be commenced. So this is a specific loan and 1st December 2018 I can start capitalizing and continues without interruption until after 31st March 19 or just 4 months. So is it substantial period of time? Let's find out. During the period of construction, entity incurs directly attributable cost of 1 lakh in December, 2,50,000 in each month. For simplicity, it is assumed that these costs are incurred on the first day of each month. Each month, the borrowings, less amount that is expected for the building works, are reinvested and earned interest at 5% per annum. For the year ended 31st March 19, entity incurred interest expense 1,11,667 on 10 lakhs loan and earned 37,917 as interest on the reinvested portion. And we are like, we will compute. We don't need this computation. We will do it. Determine the amount of borrowing cost to be capitalized to the qualifying asset. So this is a qualifying asset they are telling. So you cannot assume this is not a qualifying asset. How much capitalization you can do for this qualifying asset? What I'll do? I can capitalize from 1st December. 1st December. So December, January, February, March. I can capitalize for this 4 months. December, how much amount? Is it on 1 lakh or is it on 10 lakhs? Is it on 1 lakh or is it on 10 lakhs? So it is on, because it is specific loan, it is on 10 lakhs. Because if it is specific loan, on entire 10 lakhs, we need to find out the interest for that construction period. So 10 lakhs into 12% for 4 by 12 was done fine, but there was a change in interest rate. So 10 lakhs into 12% into 1 by 12 first year, that first month December. 10 lakhs into 12% into 1 by 12 second month. 10 lakhs into 13% into 1 by 12. 10 lakhs into 13% into 1 by 12. This is the total interest expense which we can capitalize. 10 lakhs into 12% into 2 by 12 total. So 10,000, 10,000 and 10 lakhs into 13% into 1 by 12. 10,833, 10,833. So it is 40,000. 41,666 is the interest that can be capitalized. This is the interest that can be capitalized. But there is, if it is specific loan, this total amount of interest that can be capitalized minus short-term borrowing, short-term investment incomes, if any, should be deducted. Is there any investment income? So what they're telling, in December they used 1 lakh. In December they used 1 lakh means 9 lakhs is reinvested because I got a loan of 10 lakhs and I used only 1 lakh in the first month. 9 lakhs was invested. So in December 9 lakhs into and invested for how much interest? 5%. 9 lakhs into 5% into 1 by 12, I would have received as interest income. 9 lakhs into 5% into 1 by 12. 3750 I have received as interest income. Then January, what they're telling, 2 lakh 50 is used, which means 9 lakhs minus 2 lakh 50, 6 lakh 50 is invested and I got 5% interest for 1 month. 2708. And February again 6 lakh 50 minus 2 lakh 50, 4 lakhs into 5% into 1 by 12, 1666. And last 1 lakh 50 into, because 2 lakh 50 keeps reducing. So how much interest income you have received during this period? 666, 8749. So 41666 minus 8749. 30, correct. 32917 or 32916. This is the interest that can be capitalized. Are you okay? Now 19 and 20. Two more questions we have. So first let me finish off this 20. Why finishing of 20? Because that is very easy. So let's finish off this 20 and then come to 19 and close. A Limited exchanges car X with book value of 13,000. A Limited has given up a car X of 13,000 book value and fair value of this is book value and the fair value of this car X is 13,254. So this from A, this is given up, and what A has received is cash 150 and car Y with fair value 13,100. The transaction lacks commercial substance. Do you remember, if the transaction lacks commercial substance, new assets received will be recognized at book value of asset given up. Book value of asset given up is 13,000. So book value of assets received is cash 150. So what will be the value of car Y? Car Y should be 12,850. Car Y value should be 12,850. Is that okay? A basic intermediate level question. Because why I'm telling intermediate level, it's already there in intermediate study material. That's why 12,850. Now, what is this? Consolidated cash flow statement. See in day 7. First, you need to prepare you need to be knowing the format of cash flow statement. I need to be remember the format of cash flow statement in direct method. And Z Limited had acquired a subsidiary V Limited during the year 11-12. X Limited had acquired a subsidiary V during the year 11-12. Summarized information from consolidated P&L and balance sheet with some supplementary information have been provided. So if a consolidated P&L is given for cash flow statement, I should be starting with I'll be starting with PBT. Format of my cash flow statement, operating activity, profit. We should start with profit before tax, 84,000. Then I need to add back, eliminate. So this I cannot eliminate, this I cannot eliminate, this I cannot eliminate. I should add back 36,000 non-cash. This is operating expenses. I should add back 4,800. Why? Non-operating. So 84,000 plus 36,000 plus 4,800, 1,24,800 is cash flow. Cash flow before working capital changes. This is profit after tax is 66,000, but how much cash you have generated? So cash is before tax cash I have taken, added back non-cash items. This is the cash flow before working capital changes. Now what are the working capital changes? Current assets. These two are working capital changes. Then current liabilities, tax payable. Trade payable. Trade payable. Other information, all of the shares of V Limited were acquired for 88,800 in cash. The fair value of assets acquired, inventories, trade receivables, cash, PP, trade payable, long-term debt, goodwill. This is how we paid a consideration. This is the consideration we have paid to V Limited. Prepare consolidated cash flow. So what should I do? What should I do when I take the working capital changes? Working capital when I take, I'm taking trade receivables. Trade receivables, current year the current year inventory is 36,000. That includes an inventory which I acquired 4,800. So this was 36,000 minus 4,800. So 31,200 is my inventory. Compared with last year inventory 42,000. 42,000 and 31,200. There is a decrease in inventory of 10,800. Decrease in inventory is to be added. Add. Decrease in stock. Inventory. Decrease in stock 10,800. Okay, now trade receivables 64,800. Current year trade receivables of the group is 64,800. But trade receivables I acquired in the current year is 9,600. So this is acquired from subsidiary during the year. So 64,800 minus 9,600, 55,200. Of this 55,200, opening was 60,000. So again, decrease in trade receivables is 4,800. Decrease in trade receivables is to be added. Decrease in debtors is to be added again. How much is decrease in trade receivables? 4,800. Then decrease in trade payables, or decrease or increase, let's find out. So trade payables was closing 81,600. How much is the trade payables I purchased from my subsidiary? Oh, 38,000 I purchased from subsidiary. So 81,600 minus 38,000 is purchased from subsidiary. So 43,600 is my 43,600 is my 43,600 or 40 38 38,000 43,600, and my opening was how much? Opening is 72,000. So 72,000 minus 43,600. How much is the 72,000 opening? The decrease is 28,400. 28,400. Decrease in creditors is to be deducted. Less 28,400. But there was a mismatch here. 4,800 plus 9,600 plus 2,400 plus 1,32,000 minus 38,000 minus 43,200 plus 21,600. Here this is a typing error. Trade payables here is 38,400. So there is a typing figure, there is a mismatch. 38,400 വന്നാലേ tally ആവുള്ളൂ, correct ആവുള്ളൂ. The totals match ആവാൻ. So in the answer solution they have taken 38,400. I have noted. So here our 400 difference വരും, 28,800 is to be reduced. So cash generated from operations will be 84,000 plus 36,000 plus 4,800 plus 10,800 plus 4,800 minus 28,800. It is 1,11,600 is cash generated from operations. Cash generated from operations is 1,11,600. From that I need to deduct income tax paid. How much is income tax paid? To find out income tax paid, what should I do? There is opening provision for tax. How much is opening provision? Previous year opening provision is 13,200, closing provision is 14,400. So opening provision by balance brought down to balance carry down, closing provision 14,400. Provision created in the current year. Provision by P&L 18,000, P&L 18,000. 13,200 plus 18,000 minus 14,400. Tax paid is to bank. Tax paid is 16,800. So tax paid is 16,800. So 1,11,600 minus 16,800. So cash flow from operating activities will be 94,800. Cash flows from operating activities is 94,800. My first part. Now cash flow from investing activities. How much is cash flow from investing activities? Investment 88,800. 88,800 we paid, but we acquired a cash of 2,400. When we paid 88,800, we acquired 2,400. So net cash flow from investing activity, I paid 88,800, but in that I acquired 2,400. So 88,86,400 outflow. Cash flow from financing activities. So clearly mentioned that there is an interest payment. How much is the interest cost? Interest paid 4,800. So we'll find out cash flow from operating activity 94,800, invested 86,400, interest paid 4,800. So net cash generated or net increase in cash and cash equivalents is 3,600. So cash and cash equivalents, when I check, opening cash and cash equivalent is 6,000, closing is 9,600. which means 6,000. It is 9,600. So cash flow statement, just intermediate level cash flow statement question only we are getting. This is very simple and basic already in the study material. So just focus on that ESOP question. Just focus on that Ind AS 23 borrowing cost, financial instrument question, but rest everything is very basic question. Even Ind AS 23 is also an okay question. Just financial instruments and ESOP. These are the stars in this RTP. And do you have any doubts to ask? If you have any doubts, you can ask, or else you can leave. This is your precious time. Invest maximum. Still, you have time for revision. So do your best. So if there is a doubt, just ask, or else you can leave.